Good evening, Des and Leah and Fayyad. Good evening, folks. Good evening, and welcome to Thursday night and TikTok Live. Time to answer some questions. See if I can answer some questions for you guys. Naledi and Daddy Deal and Rian. Good evening, folks, and welcome. I hope that this content and what we discuss here will be of value to you tonight. And I look forward to answering or trying to answer the questions that you have. So let's see. Trying to get the screen to work properly. Okay, that's better. Good evening. Any questions? You're welcome to pop it in the chat. And then I'll see if I can answer you, help you out, anything like that. While we are waiting the first person to pop a question in the chat, I get a lot of questions on tax-free investments. And the funny thing is that these days I get it very often that people ask me, can I go and put in 500,000 Rand immediately into a tax-free investment? Or can I draw 300,000 Rand, for example, if I've already built it up, and then can I draw 300 and put in 300 again? And the answer is very straightforward and simple. You can't. You can only put in 36,000 Rand per annum into a tax-free investment, okay? Until you've put in 500,000 Rand over the lifetime of your investment, which takes about 14 years if you do the full 36,000 Rand per year. And then you filled up your 500,000 tax-free, and then all the growth that you earn is tax-free. And that's actually as easy as that. I'm not the biggest fan of tax-free investments, I must be honest, because if you go and look at the difference in terms of the difference in growth between a taxable investment, if you want to call it that, such as an endowment, and a tax-free investment, not really big, not really much of a muchness. Ansman, do I get tax on my winnings at the casino? Sorry, mate, but you did not win last night. That's the problem. Mr. Ansman, you should be in bed by now, recovering and whatever the case might be. And if you won money and you did not buy us a beer, then you're definitely going to get taxed. There's no two ways about it. It was fun seeing you, Anthony. I hope you have a good time here and get back to Cape Town safely, mate. So yeah, that was just a quick, I thought just something of interest with regards to tax-free investments, because I'm getting so many questions on that. And people seem to also ask this thing, how much of my money can I draw out tax-free? Everything on a tax-free investment, that's the thing. Tax-free investments, everything that you put in, all the growth that you get, everything is tax-free. So if you do start a tax-free investment, start it early in life so that you can really benefit. The real benefits of tax-free investment is seen over the long term. It's not seen over the short term. And it's unbelievable how many people open a tax-free investment because they want all this tax-free growth and whatever the case might be, and then they withdraw the money on a yearly basis to go and pay for their holiday to Cape Town or stuff like that. And to me, it just doesn't make sense. How does people think? You open a tax-free investment to get the tax-free benefits of the growth that's tax-free, and then you go and use it in any case. Good evening, Nailene, good evening. Thank you for greeting me, and please pop in a question. Let's see if I can answer something. The tax-free thing I just threw in there because it's something that is just popping up on a regular basis these days. But yes, folks, anybody, any questions, any comments? I see there's a lot of people that, a lot of people these days that get very upset with me because I do not promote cryptocurrencies, purely because I don't like the aggressiveness of the investment, and but it's a good thing for a long time again. Yaku says, I have a tax-free benefit with Sanlam. Great stuff, Yaku. If you've got a tax-free benefit or tax-free investment with Sanlam, the best way to use a tax-free investment is to leave it until retirement and actually start drawing an income from that tax-free investment at retirement. because then you can reduce the income that you need to take from stuff like a pension fund or retirement annuity or anything to that effect, and supplement your income with the tax-free investments income, and in that way bring down your own tax that you're going to pay. It's a wonderful thing to use, especially for everybody that is always wants to get away from the tax man. Let's put it that way. Which bank is the best in investment for a income around 500,000? Eunice, I do not deal with bank investment, mate, and quite frankly, if that is the type of money you want to invest for an income, or if that's the type of income you need, then you're going to need a substantial capital amount. And I would not be investing it in any bank. Now, like I say, I'm not a specialist on bank investments, okay? I know that there's things like fixed deposits and 30-day call accounts and money market accounts, and I've got a reasonable idea on how the different investments of the bank work, because I actually spent 2.5 years working at a bank many moons ago. But any investment in a bank must be purely, according to me, for emergency funds. If you want an income from a capital amount, okay, be that 500,000 or be it 50 million because you need a 500,000 rand income, I will not be putting my money into the bank. Number one, the interest rate that I'm going to get is never going to be as good as what I can get with an investment company investing it in good funds. Number two, it's never going to be a tax efficient investment. So if you do invest in a bank, and let's say you get a 9% return on your investment, but now you have to go and deduct called 40% or 36%, because of the tax that you have to pay on that interest, you end up with a real return of like 6%, 5.5%. And if you go and you compare it to what inflation is, it means that your money does not grow. Your money is not giving you a return on investment. So you are effectively actually seeing the same amount of capital, maybe getting a little bit more capital, but your investment is actually depreciating in value, even though it looks like it's going up and up from a purchase point of view. How much can I buy with this 10 Rand point of view? Your money actually loses value on a year-to-year basis. So I will not go to the bank investment. Eunice, I would strongly advise you to look at something different. Robin, Sophia, hello, should I be trying to manage my own investments or go through a financial advisor? Robin, you know what, that's a very difficult question to answer these days, because there's so much help out there. As a matter of fact, I mean, you could go and speak to ChatGPT these days, and ChatGPT can give you answers on finances. So anybody that feels confident and competent to look after their own investments, I have no problem with that. I do know, however, that there is actually so much information. It's actually too much. We are bombarded with too much information. Then it becomes difficult to take the truth and the BS and separate it from each other. So I would say, if you are not a specialist or trying to be a specialist or studying investments in the markets in depth, okay, if you are not doing that, keeping up with it, then rather get yourself a financial advisor. Make use of a specialist. I used this comparison the other day with somebody. I said, if you get a sore throat and a bit of a cough or whatever, you run into the pharmacy, you get some cough syrup, but maybe a tablet or something that you suck on, and you self-medicate yourself. No problem with that. But if that doesn't go away and it becomes worse and worse and worse, you're going to see a doctor. And if the doctor doesn't understand, that doctor will refer you to a specialist. So if you're going to treat your health like that, treat your finances like that, exactly the same way. Okay. Join my fan club. I always wonder how these things pop up. And there we go. Let's see what Henny is saying. Henny Libba, hi Corey, I'm getting a small amount of plus minus 250,000. Where's the best place to invest it? Henny, it's amazing how often I get this question. Not with the same amount, different amounts of money, but where's the best place to invest it? And you know what? I really can't tell anybody based on just one question. It's like standing next to the fire, and then your mate is going to tell you, no, you have to buy crypto, or no, you have to buy gold. I mean, everybody wants to have had 2 or 3 beers, are the smartest financial advisors in the world. But the problem is, if I don't understand what your exact circumstances is, if I don't know what your income and expenses look like, your assets and liabilities, your financial dependence, what the money is going to be used for, when the money is going to be used, how long it has to be invested, how much risk you can take, I cannot give you an answer. And the thing is that we all have different circumstances. If you are talking to somebody that has lots of money, no debts, well off, they can take that 250,000, they can gamble with it by putting it on super high risky investments. If you are talking to somebody that's got a lot of debt, and they want to invest, the best investment might actually be to take that 250,000 rand, go put it on some of your debt. It's better to pay off a credit card with a 24% interest and not pay that 24% interest anymore and invest it on an investment where you're going to get a 10% return. So I know I'm taking a bit of time in answering you, Henny, but I get this so often. I think it's so absolutely crucial for people to understand that you have to do some proper financial planning in order to decide what you do with your money. So what I normally say to people is, you also don't want to jump in and get an answer and do it tomorrow. If you are still unsure, put it in a bank account, park it in a bank account, and get some financial advice, or go and do your research or whatever, and then take a bit of time. If that money lies there for a month or 2 or 3, it's not a problem. You're not going to lose a ton of money in terms of growth, or whatever the case might be, but then at least you've got time to do planning, proper planning, get a proper recommendation, and then invest the money in a good investment for yourself. I hope it answers it for you, Henny. Naileen says, hi, I hope you're well. So I've collected my 1/3 pension. I want to spoil myself and buy a new car. Naileen, well, fantastic. Congratulations. I wonder how much it is. So Naileen, here's the thing in terms of buying the new car. Okay. If your financial situation allows it, so the income that you're generating from your 2/3 is sufficient, you've got some emergency savings, you have a need for that vehicle, etc., etc. Once again, bunch of information. Then yes, go and spoil yourself with the car. I actually had a meeting just before we started TikTok Live now with people that has a substantial amount of money that they're not needing in retirement. And they said, but we want to go and take an overseas trip. We want to go and visit our kids overseas. And I said, well, do it. Take the money, go do it. You've got the funds. And based on the planning, there is sufficient of it, and we are going to grow your money into the future to sustain you in your older years. So if that's the same for you, then you do it. If you're not sure, however, do what I just told Henny. Get some financial advice, do some planning with a financial advisor, and then make your decision. Robin Sevilla says, I'm 26 at the moment. I've taken out life cover on my parents, but I have no other investments. Well, if you're 26 and you've taken out life cover on your parents, that is already a pretty good investment. Second thing is, one have to go and look at their ages, how much capital you have taken, because obviously you must remember now, let's imagine you've taken out 1 million rand life cover on mum and 1 million rand life cover on dad. And touch wood, this will not happen, but your mum or your dad passes away tonight. Then it means that you will inherit 1 million rand tomorrow, and you can invest it and you can grow it until you're 26 now, let's say 56, 30 years. And that million is going to grow substantially. But if mum and dad do not pass away, okay, and you keep on paying, and then they pass away in 20 years from now, and now that 1 million rand pays out, okay, it's still a good investment, because the premiums that you paid and what you're getting in terms of life cover is always going to make it worth your while. But you didn't get the 20-year growth on that 1 million rand that you would have gotten if mum or dad passed away tomorrow. Okay, so I would say that's a good thing to do in terms of future planning for yourself. But, big but, do go and do a calculation to see what you're actually going to need into the future. And it doesn't matter what you need it for. Retirement, buying a house, putting in a swimming pool, overseas holiday, whatever the case might be. And go do additional investments. at the end of the day, if you can save up at least 15% of your income on a monthly basis, you're on a good wicket. If you can save up more than that, you're in a great wicket, then you're going to do fantastically well. If you don't do it, anything less than 15% that you start investing, or every year you're not investing, just makes life more and more difficult to try and play that catch-up game somewhere into the future. So there you go, Robin. That's my 10 cents in regards to the life cover on mum and dad. User says the 3-pot system only benefited. I don't really want to talk about the 3-pot system because it gets my hair up every time. It only benefited government, huge tax income, absolutely huge tax income. But this is the thing. Us, me, you, every individual in South Africa have to take personal responsibility for our own decisions. There was good intentions with regards to the 3-pot system, and if people used money from the 3-pot system based on the good intentions, we would have a lot less poverty in South Africa. But what happens is nobody used it for what it was intended for, to go and pay off debt. And now they end up with even less money in retirement. So yes, the government, they scored big time with regards to tax income, and everybody is upset about it. But as individuals, we have to take responsibilities for our own actions. And there's millions that was withdrawn with this 3-pot system. And if you withdrew it and you did not use it for good, and you will not believe how many stories I've heard of people going on holiday, buying shoes, buying expensive handbags, the biggest load of crap in the world. If you did that, then it's your own fault if you do not have enough money, and you have to take the responsibility and say, they put it on the table, but it doesn't mean I have to use it. You know, it's one of those things. Somebody next to you might be smoking a bit of weed, but it doesn't mean that you have to do it. You have that choice always. Eunice says, but which is the best to invest? Eunice, best to invest? I'm not 100% sure what you mean by what is the best to invest, Eunice, because, and the reason why I say that is, the best to invest depends on, once again, the person. So over and above the fact that we've got this thing that we have to determine all these personal things about you, how much risk you can take, etc., etc. Once we've tried to do that, then we must also go and look and say, well, what's the tax situation? What's your personal tax situation? This is going to be better to take out a retirement annuity, endowment, unit trust, alternative investment, tax-free. There's so many options. But every one of them has a different tax implication and different growth implication. So, once again, as much as I say you must get information and get advice and structure in terms of your investments, as much as I say that, you must also understand what you need to invest that money for and where will it work best for you from that tax and growth point of view. So I'm going to keep on saying it. Get financial advice. And there's hundreds and hundreds of ways to figure these things out. Fly Girl 442. If I'm not mistaken, we just set up a meeting in the next week or so. Fly Girl, so I'm looking forward to meeting you in person. What is my opinion on S&P 500? Are they worth it? The S&P 500 is worth it. What we have to understand about the S&P 500, that is a stock exchange, okay? S&P 500 is a stock exchange, like we've got the Dow Jones, like we've got the Joburg Stock Exchange. So what is then done is funds are created, okay, by companies, and they call it the S&P 500 fund. And that fund will then mirror what the market is doing. So what they do with the investment is, let's say you're investing 100 Rand a month, just to make it easy. And on the S&P 500, there's 50 companies, for example. And then they go and categorize all 50 companies in the S&P 500, and they say, if all these companies together was worth 1 million Rand, the company right at the top is worth 100,000 Rand of that million. The next company is worth 99,000, 98,000. So they go and do this. And then they say, okay, my 100 Rand that I have, I'm going to put it into this fund, which is going to mirror exactly what this S&P 500 looks like. And basically every day at the close of business, they go and they rebalance that fund. So they go and take money from company A, that's the biggest, put it into company B, depending on how the percentages has changed. And so in that way, you see a fund that exactly tracks that stock exchange. Now, is it good or is it bad? I think it's very good in the sense that you can go and look at any stock exchange, basically any good stock exchange, and they all go from this point to this point. Lots of dots in between, but they go up. So you always see good growth on those. So I think it's a good investment. But then you have to understand once again what that risk is in that investment, and know that the growth that you're going to get is going to mirror the stock exchange and will be in line with that risk category. And I like actively managed fund, because if we talk about the S&P 500 type of fund, it's a passively managed fund, which means that the portfolio manager doesn't have to go and decide, okay, I like this company, I'm going to buy there, I don't like this company anymore. An actively managed fund is where a portfolio manager does that. I just prefer those. But at the end of the day, I do put people's money into stuff like this, especially when they've got a medium or a more medium risk profile. Okay, so you get people that are very conservative on this side, people very aggressive on this side, and in between you then get medium high, etc., etc. So for people with medium risk profiles, it will be a good fund, and if a person wants to invest in it, then I'll put them there. Thanks, Kunai. I will buy that car. Nalene, remember one thing, I'm happy if you're going to buy the car. I'm really happy. But remember, I'm not advising you to go and buy the car. I'm telling you that you have to look at your personal financial situation and the capital that you have and what you need it for in the future. But if you've done the calculations and you decide based on what we've just quickly touched on here that you can buy that car and you're going to buy it, enjoy your new car. Absolutely go and enjoy it. Sorry, folks. Let's see where we're going next. Robin Sofia is asking, thank you. I am so confused on the investment because there's so much advice. Top 3 as a 2-year-old. Wow. I know, Robin. I know there is a lot of information out there. Hey, and that is why I think financial advisors will always have a role to play. Robin, I don't even know all the different companies and investments and everything. Trust me, I get guided again by other professionals. I have learned how to give financial advice to people. I know what to look at, what to advise people on in terms of their needs and whatever. I know how to structure good portfolios based on the economists and the portfolio managers that I deal with, the companies I deal with, and the seminars that I sit in on, the webinars I sit on. Trust me, I attend at least 1 to 2 of these per month to make sure that I keep myself up to date. And then the one thing that I must tell you, Robin, is I attend only 2 or 3 companies' presentations, because it's impossible to attend everybody's. And you will not believe me how often I get it that I advise people to go to company X, and then they come to me and I say, yeah, but company B and C are doing so much better. And I just don't deal with company B and C because I can't support 300 different companies. So I hear exactly what you are talking about, sir, and that's why I say, let yourself be guided by a good financial advisor. And if you find a good financial advisor, the relationship that you will build up with that person and the guidance that they will give you for the rest of your life, if 2 of you can walk like this, it's invaluable. My top 5 clients, I promise you, if I put their names and their telephone numbers in this chat tonight and I say anybody can phone them and ask them, my top 5 clients I have been dealing with for the last 20 to 25 years that we've come along. And those guys will not speak to anybody else except for me because of the trust relationship that we built and the asset base that we've built for them over the years. So find yourself somebody good and you will never be sorry. You will never be sorry. 16, RR, hi Corne, is there a calculation tell one that you're in a good financial... Oh, is there a calculation that tells one if you are on a good financial path? RR? Yes, there's lots of different calculations. There's so many tools out there that you can go and use. But the calculation is not necessarily going to tell you if you're on a good financial path. What is going to tell you is understanding what you're working towards. So what is your end goal? And then seeing if the financial decisions that you've made is going towards that goal. That is where I, as a financial advisor, really earn my income. Is I have to be able to show people, based on these calculators and everything that we use, I have to show them what their goal is into the future and what we are doing for them now if we are going to reach those goals. So once again, I'm going to say again, you can go, and there's plenty of these that you can go and find on the internet, companies that you can check, whatever, and you can go and do your own calculations, but find yourself somebody that you trust. It will be wonderful when financial advisors get to the point where they manage to explain to people, this is where you are now, this is what we have to do to get you there, and they can put it into simple terms. Now, that's when they really become very valuable. Okay, who's next year? It feels like I've skipped 110 people, but I haven't really. Cool Cat says, minimum amount I can save a month to build a positive balance. 10 Rand. Cool Cat, sorry. This is the thing. If you start saving 10 Rand today, okay, if you don't have any more money and you start saving 10 Rand today, and you save 10 Rand every month, then by the end of the year you're going to have 120 Rand, which you would not have had if you didn't put away 10 Rand from the first month of the year. So it's as easy as that. Any amount is a good amount to go and invest in order to get a positive result somewhere into the future. Any amount. What will be a good amount or minimum amount for you will depend on your own personal affordability. Some people, trust me folks, I work with people that cannot put away more than 350 Rand a month. And then we do it for them. We help them to invest that 350 Rand to the best of their abilities. And then I have clients that put away 50,000 Rand a month. So it depends absolutely on what you can and what you cannot. What is your financial means? That is the minimum amount that will give you a positive balance. The important thing with investments is starting early and being consistent every month for years and years and years. That is the secret to successful investment and successful wealth building into the future. Cool card, I hope I answered you. Michelle says, so it's bad to take, I think you wanted to say take from the 2-pot system or the 3-pot system, and you would be 100% right. It is bad to take, because the moment you take there, you pay tax. Now, over and above the tax that you pay on money that wouldn't have been taxed, you also don't have that money anymore. It doesn't grow anymore. You get to retirement, you've got less to live on. So definitely not good. Nalene, it's okay, calculations done. Well, good. Then I'm happy for you, Nalene. What is... Oh, I've got two different things here. Sorry, folks. There's a lot of people that pop in and out, but not so many people asking questions. I just thought that I missed something here, but so far so long. Nalene says, it's okay, calculations done. Well done. Nalene, go and buy that car. Enjoy it. Cool Car says, understand things. Well, then I'm very happy. I am really happy if it makes sense. This is what I do this for. Hoping to give people guidance, hoping to give people a bit more clarity. My Gigi, hello Corey, can you transfer tax-free savings to another tax-free savings? Yes, you can, indeed. It's actually something that we are doing more and more regularly these days because people open tax-free bank savings accounts and then they find out afterwards, but I'm only getting 4% or 5% growth, and then they see portfolios which is getting 10 and 12 or 14%. They realize that even if they're getting tax-free growth for 4%, the investment is going to be worth a lot less in the future than the person that's got an investment that's got a 10% growth. Because that 6% difference in growth, even when that person pays tax on it, is still far, far more than the tax-free investment, which is getting 4%. So we are doing that on a much more regular basis. Let me see if I can move this thing. I can indeed. Well done. So we are doing a lot more of these tax-free investments that we move these days from one institution to another. Other thing that's interesting is that a lot of companies that has tax-free investments is actually stopping it. They're not doing it anymore. And it's because it is not worth it for them to do it anymore. So that's something interesting to just think about. Companies who has tax-free savings or tax-free investments are saying, we're not going to offer this anymore. Interesting indeed. Robin says, what if I don't know my exact end goal but just want to build wealth? Well, Robin, that's why I'm using the 15% as the guideline, okay? So this is where we get to the 15%. It's been calculated over and over and over and proven over and over and over that if you invest money, okay, for a period of 35 to 40 years and you invest 15% of your income, that when you get to your retirement, the capital that you would have built up will be sufficient to carry you for the rest of your life in terms of income. So we can basically say that we use that as the benchmark in order to start the planning process. Now, for somebody like yourself that says, I don't know what the end goal is, even if you just start investing this 15%, at least you know you are on track, that if you wish to actually retire at some point into the future, that you know, okay, well, at least I know I'm going to be able to do that. And trust me, as you go on in life, you will start getting more clarity with regards to what you want and what you don't want to do with your money and with your investments. So just start with that 15% so that you don't fall behind. And once again, sit down. Anybody that can help you with clarity in terms of a proper planning session and can guide you with this stuff will be able to, in the long run, help you to get to that point where you know what you're going to use your funds for. Okay, so just start, my mate, start. What if I don't exact goal? Okay, that was Robin. Then Flygirl, would you say that you see higher returns on the S&P 500 as opposed to investing into unit trust? Well, so Flygirl, here's the thing with regards to investments. Unit trusts, okay, in South Africa, there's more than 300 companies that offers unit trusts. These companies, at last count, offered more than 1,800 different unit trusts. Okay. So now, if you go and look at all these 1,800 unit trusts from this side right to that side, and you plot them, you're going to find some of those unit trusts that offers like 3% return on investment, really, really bad return on investment. Up to the other side, where you're going to find some of them that's getting 20-25% return on investment. So now you look at your S&P 500 and you say, where does that fall in? So the S&P 500, let's say it falls into a 12% category. So the unit trust that is giving you 25% is obviously doing better than the S&P 500 is doing 12%. But here's the important thing that one has to go and look at, is you must go and look at the term, okay? Because it's very possible that a unit trust can give you, like which has happened in the last year, on a lot of different unit trusts that are medium risk unit trusts, which were giving anything between 18 and 23% return on investment over a 1 year period. Over a 2 year period, the average then comes down to say 19%. But then if you go and look at that unit trust over a period of 10 years, then you find that the average return on investment was 10% per year. Okay, so the unit trust that looks fantastic because it's given 25% this year on a 1 year basis, over a 10 year period, even with the 1 year 25%, over the 10 year period, it's only giving an average of 10%. And then the S&P is giving an average of 12%. So now suddenly S&P is better than the unit trust. So it's impossible, really, for anybody to say, listen, yeah, is it better to be in the S&P than what it is to be in a unit trust? Because it's going to depend on the type of unit trust that you're investing your money in. And over and above it being the type of unit trust that you're investing in, it's going to be determined by the amount of years that you want to be invested in. So what you as a client must do, and what your financial advisor must then do, is to help you and guide you with the following. When they do the calculations and they calculate or they work out what your risk profile is, they need to then find a strategy. We call it an investment strategy, where you go and decide what it is that you want to achieve. I want to achieve a return that beats inflation with, let's say, 5%. And if that strategy is in line with your needs, then the intention, the best thing to do is to go and find a portfolio or a unit trust or something that you're going to invest in that is in line with that strategy. And as long as your portfolio then, your strategy then gives you what you need, you're winning. So if we're saying inflation plus 5% as an example, we talk about a 9 or 10% return on investment. What is important for you is that you're going to beat over this period of time, be it 5 years or 50 years or anything in between. As long as your strategy and getting to your goal says that you must get an average of 9 to 10% return on investment, and you are getting it, then you are winning. Then it is working. The goal is right. Doesn't matter if there's others that's giving 12 or 13 or 14%. That's not what you need. So I find it very... It's a nice discussion to have with people, trying to let people understand that I can never tell you whether this fund is going to be better than that fund for you, because we all have different needs. But if we understand how to plan for what we want into the future, and we do our planning according to that, we strategize according to that, then you're sorted. If you can work out and understand your own strategy and invest according, that's when you're sorted. Okay, so let's see here. I see a lot of, don't quite understand what's going on here, but never mind. How long does a Section 14 transfer take? Oh my goodness gracious, mate. Section 14 transfers, that it's not supposed to take more than 6 weeks. Okay, it's not supposed to take more than 6 weeks, but it can take easily 6 or 8 months. We've been through it so many times. So it is very possible that you can wait months for it to be finalized. It's not really too much of a problem, and the reason why it's not too much of a problem is because where your funds is at the moment, you're still earning your growth there. So while it is lying in the previous retirement annuity, that company must still give you the growth that you are getting. And if, let's say, you're getting an 8% return on your investment at the moment in that specific, in that specific portfolio, and the new portfolio that you're doing is going to give you 10%. That 2% difference for that, call it 2 months to 6 months that it takes for the transfer to happen, is not going to have a major impact on your long-term goal. Okay, so Section 14s can take really, really long, but at the same time, it's not something that you should worry about. Folks, I don't know what the heck is happening here. Something is definitely happening because I'm not seeing anybody putting in any more. I'm not seeing anybody else putting any more comments in the section or giving any more questions. And I see a lot of people which seems to join and then they go off again, which is something that happens on a regular basis. But normally they don't, normally the whole TikTok thingy doesn't just stop. And you don't see anybody sticking around. So I'm trying to figure out what's going on here, but maybe I should ask my wife to pop a question in quickly so that I can get an idea on whether this thing is working or not working. But I have just a question that, there you go, TJL, thank you very much. I was going to ask my wife to do exactly what you did now. Test, can you see the comment? That's exactly. Thank you, my Gigi. I appreciate it, folks. Yes, I tell you, you guys are starting to feel like family. Chatting with you guys on a Thursday evening. Thank you, Nadine. I see it is working. Yeah, you guys are lekker. Thank you. Matutu, I've answered one or two of your questions in the past. Okay, are unit trusts good for long-term investments like tax-free savings? I usually see people recommending ETFs. Okay, so your ETF is basically what I referred to earlier as a passive fund. Okay, that is when you put your money in into a portfolio that is not actively managed, where you don't have a portfolio manager that's buying and selling shares based on what he thinks the markets are going to do for you, but where you basically go pick a specific sector or something of the market which you want to track, and you do an investment that looks exactly like that, and so every morning somebody just presses a button to rebalance everything. They don't have to actively manage the fund. Okay, so that is how your ETFs work. And there's some brilliant ETFs. The S&P 500 that we talked about now, great. Citrix, there's a brilliant one that the Citrix have, absolutely. Some of the portfolio managers I deal with their actively managed funds, they actually have a portion of their capital into those same ETFs. So is it good? Is a unit trust good for long-term investment? Yes. Like a tax-free savings account? Absolutely. Unit trust, the only thing with unit trust is as long as it's invested into a tax-free investment, tax-free savings account or tax-free investment, whichever, if you make use of a unit trust there, okay, no problem, because there's no tax implication because it's tax-free. But if you invest in a unit trust and it's not in the form of a tax-free investment, then one has to go and look at your personal tax rate. And the reason why you look at your personal tax rate is because on unit trust, you are taxed on capital gains tax the day that you withdraw your capital. And that day when you are taxed, you're taxed on what your personal marginal tax rate is. Okay? So basically, let's say you've got 2 million rand in investment, 1 million rand is what you invested, the other million is what it's grown by. So when you withdraw one day, that million rand capital gain that you've got, the growth that you've got, that will be taxed now in line with your personal tax rate. So if you are on anything from a 31% tax rate and up, you are getting taxed pretty severely. If you are in an endowment, okay, and making use of portfolios, not unit trust, because the same thing applies there, then you are taxed inside of the fund at 30% only. So if you invest in a unit trust and your personal tax rate is 30% or lower, the unit trust will normally be the better one, because when you withdraw your money in the future, you will be taxed at your personal tax rate, which is 18 or 20% or 26%, etc. But if you have a tax rate that's higher than 30%, 31% up, then the endowment becomes the better option, because then you are taxed within the fund at 30%, while in your personal capacity you get taxed at 45%, for example. So you're saving yourself 15% in taxes. So the unit trust is indeed a very good long-term investment. But as much as it is a long-term investment, it depends on the person. I cannot give you advice to go and put money into unit trust when you are in a tax bracket of 31% or higher, then I should be investing you or helping you to invest in endowment. And that's part of the things that a financial advisor must look at before they advise people. And then both the unit trusts and the ETFs that we're talking about are either a unit trust or portfolios, and that is what goes into your investment. So which one of the two is going to work best for you is going to depend on which type of product you're taking. Okay? And then obviously, once again, a strategy that we talked about, if you are on a low risk, medium risk, or a high risk strategy. Okay, Matutu, I hope I've answered you, mate. Leonard says, I work for Transnet and they have our pension with Momentum. And I have my pension with Momentum. In what circumstances can you get all my money? So Leonard, if you resign from Transnet before retirement age, okay, then you can get all your money. You can either withdraw all the money and then pay substantial taxes, and that's not a good idea, or you can move it into a preservation fund. Then it gets moved over tax-free, but you can't access it. And I believe that your question is literally, how can I get my hands on this money? You have to resign before the age of 55 in order to withdraw the money. But Leonard, my mate, please don't do it. Yes, I cannot tell you folks how many people I have spoken to and seen in my life that at some point left the company, withdrew their pension or provident fund because they wanted to pay debts or they wanted to do this, and they promised themselves, I will make up this money, once I've paid off these debts, I will go and put more money in to catch up with what I have. They never do, and they never can, and when we get to retirement, it's always gnashing of teeth and crying crocodile tears because we don't have enough money because we've used it in our lifetime. So, yeah, Leonard, just don't do it, bud. Okay, Robin's fear. Yes, family helps us get wealth. Yeah, I suppose. If you say family helps us to get wealth, my personal opinion is family just helps you to get rid of your wealth. That's the only thing they do. Leonard, you say you're 38 years or 20 years of service. Yes, sir. So you've got basically 17 years to go before you get to retirement. Anytime between now and then, if you decide to resign from them to go and work for a different company or something, you're going to have to do something with your pension fund money, move it to a preservation fund. If you do not and you withdraw it, you're going to cry, my brother. You're going to cry. Hilton, good evening, Hilton. Cool Card says, if you have a portfolio, is the tax handled for you or you personally do the filing? So if you've got a portfolio, Cool Card, and it's an endowment, then the tax is handled on your behalf inside of the fund, okay? If it's a unit trust, there is no tax implications until the day that you actually withdraw the funds. Then at that point, when you withdraw it, then you see your capital gain, and in that year you have to pay the capital gains tax. Then you personally have to handle it. On retirement annuities, while you are investing, it's tax-free growth and you're getting the rebates, so you handle it because you have to tell SARS every year, this is what I've contributed to my RA, so you can get the tax deductibility. And then once that RA converts into an income, living or life annuity, then the income that you generate, you become responsible of paying over that tax to SARS. And actually legislation has been implemented that the companies must actually pay over on your behalf taxes, whatever the tax rate is that you are on or that you have gotten from SARS. Because some people can actually go to SARS and say, I don't want to pay 30% tax, I want to pay only 18% tax, and SARS gives them a tax directive to say, okay, you can only pay tax 18% tax, but remember, if the end of the year comes and you didn't have enough deductions and this, that, and the other, and you actually owe us the other 12%, we're going to ask it from you, we're going to take it from you. And then you have to do tax returns. So, different products different ways in which the taxes are handled, whether it's handled on your behalf or you have to handle it. TJL says, can someone as a beneficiary of a life annuity continue the life annuity on his or her own? Oh, the beneficiary. Can the beneficiary of a life annuity continue the life annuity on her own? So, yes. So, if you have a life annuity, remember a life annuity is where you take your pension fund money and you buy a guaranteed life annuity, whereby you buy a guaranteed income for the rest of your life. Now, on that guaranteed plan, you choose a guaranteed term. And the guaranteed term can be anything from 0 years, where you've got no guarantee, up to 25 years. Okay? So, if you buy a guarantee, and let's call it the 25-year guaranteed term, then what it means is that for 25 years, the insurance company that's paying you that guaranteed income must pay the income. Doesn't matter whether you're alive or dead. So if you pass away in the 10th year, they have to pay that income to your beneficiary for the other 15 years. They don't have a choice. That's it. It's just when this guaranteed term is over and you then pass away that your beneficiaries can't get anything or won't get anything. Okay. And that's also where the planning comes in. Is it better for me to take a life annuity or a living annuity? Because on the living annuity, it's a different situation. On a living annuity, you nominate the beneficiary, and that beneficiary gets given the choice in the event of you passing away on whether they're going to continue with the income into the future or whether they now want the full capital amount. I hope it answers for you, TJL. My GG, when will government amend the parameters, interest, CGT, tax-free savings? Why can't financial institutions put pressure? I think they do actually, my GG. I think they do put pressure. And they do it every now and again, but yeah, they don't do it on a yearly basis. I actually had a question from somebody today about withdrawing some money way back when, and the withdrawal was done in 2009, and when we just checked to refresh our memories, until 2014, the tax-free portion of your 1/3 was limited to 500,000, and I think it was, I don't know when exactly after 2014, but is when they increased it from 500 to 550,000 rand. I think it's 2016, 2017, somewhere around there. So they do, but yeah, SARS is not going to let them be pressured by a financial institution, SARS, they need money. They need money to run the country. So yeah. So Leonard says, thank you. So basically, I'm not a GPF member. No, Leonard, when you're working for Transnet, you're not a GPF member. You are a Transnet member. But even if you were a GPF member, would have worked exactly the same. Could have gotten it if you resign. When is endowment recommended? Do I need large sums of money? No, I don't think you need large sums of money. I think you can invest as little as 500 Rand a month or 50,000 Rand as a lump sum into an endowment. And like I said, the endowment is basically advisable when your personal tax rate is 30% or higher. If you do not require or do not see that you're going to need the money for 5 years, so that you don't have to make any withdrawals within a 5-year period. If you want to create an investment that in the future is going to give you tax-free incomes or capital amounts. So there's a number of times that an endowment is advisable. But these are the basics that I've given you now. A lot of the time when we do the planning, we have to go and determine what is going to be best for the client, a retirement annuity, unit trust, or endowment. And sometimes a combination of these products are even better. But yeah, you don't need a lot of money to invest in endowment. Okay, folks, we're getting close to the end now. Let's see what Dee says. My husband retired in August, got his 1/3 and first monthly income. Since then, have not received anything. Whoa, Dee, that is not good. If he retired in August and he got his 1/3 then and he got his monthly income then and nothing since then you must definitely find out what the heck is going on, because that is not right. Unless his first income was received at the end of October. If his first income was received at the end of October, then the next income is only due now at the end of November, which is basically now. But yeah, if it's been a month or two since the first income, you better start making inquiries big time. You have to go and find out what's going on. Okay, Naileen says, will the tax be paid before I get my monthly income from the guaranteed income? Yes. So if you have a guaranteed income and we have put in your tax rate and we set your tax rate as 18 or 20 or 25% or whatever, you will only receive the net income. The tax will be paid over on your behalf to SARS. So that's right. My GG says exactly. SARS makes it difficult as I use all strategies to minimize my tax. Yes, my GG, it does. Look, the thing is, at the end of the day, it is maybe difficult from a personal perspective. But that's why planning is so important. You know, if you do proper planning and they give you the tools to save on taxes or pay less taxes, then you must just use it. That's as easy as that. And I think you can go and have a look at anything in the world. If it's been coming over so many years, it's not straightforward and simple anymore. But I understand where you're coming from. Once again, like I said to somebody earlier, that's why I will, as a financial advisor, always have a job, because I have to help people that battles with this. That's why accountants will always have a job, because they have to help people with taxes and tax plans like this. All of that. Johan says, Naileen, you have to pay the tax once a year. You will be audited. Johan, no. Not quite, Johan, because remember what she just said. She said, do you get, will the tax be paid before I get my monthly income from the guaranteed income? And on a guaranteed income, yes. You will see that the insurer that you've got your guaranteed income from, they take off the tax on your behalf, pay it to SARS, and then pay the income to you. So no, you unfortunately not right here in what you say, Johan. You have to pay the tax once a year. You will be audited. What happens once a year is that you do your tax return once a year, okay? And maybe that's what you're saying. You do the tax return once a year, and if the tax that was deducted was not enough, then you will have to pay it in or receive back. Just so we get clarity there. Okay, folks, it is time for me to go. I'll answer one or two quickly. Patricia, what's your opinion about Marcia's videos about retirement annuities and financial advisors? Patricia, I'm sure you know that Marcius is my stepson, and you know what, I don't really want to comment on his videos about retirement annuities, because for certain people, okay, retirement annuities is not worth it. And when I say certain people, I'm talking about people that are super rich and super wealthy. But for the average person that is making good money or earning an average income or even a low income, retirement annuities are the best thing since sliced bread. So yeah, let's not go any further with that discussion. It does make me upset sometimes. Johan, thanks. I heard otherwise. Oh, okay, good, Johan. Oh, that's Nalene. Oh, and Johan saying is, I'm talking about something else, annuity. Okay, so Kunai says that what I heard, tax will be paid to SARS on my behalf. I will receive post-tax. Correct. Convoy says, is this an open Q&A? Yes, it is, Convoy, but unfortunately for you guys, I am on my way now. It is 7 o'clock in the evening. I am tired. I've had a long day. I'm going to grab something to eat and then I'm going to sleep. So Convoy Seth, please tune in next week, Thursday again. Ask your question there, or go on to my DMs or my WhatsApp and ask a question. I promise you I will answer you back. Can RAs be trusted since they are trading your investments? No, they're not trading your investments, Convoy Seth. Definitely not. Now I'll answer this one for you quickly. RAs, they are not trading your investments. So you've got a complete different or incorrect understanding of retirement annuities. Okay. Send me a message on my WhatsApp number, which is in my profile. I'll answer you a bit better. Thank you, everybody. Have a wonderful evening and have a wonderful week. And I look forward to chatting to you all again next week, Thursday. Keep well. Thanks a lot. Bye-bye.